Over a year ago, I made an analysis of GoPro, and since then the stock is down by 55%. So I made the right choice not to invest in the company. But today the company is at a better price compared to 1 year ago because it is falling. So is it a buy? That's why I decided to look at the stock again, and there are a few things that are interesting to this stock. You have to look at the balance sheet and you have to look at the income and cash flow statements separately to be able to find the right valuation of the company. This is not something usual that I usually do, but today this is what I want to explain to you why it had to be done in this way. Let's look at the balance sheet first. If you are going to read this book, Security Analysis by Benjamin Graham, you will learn something called the net current asset value. If you take all the current assets of a company, and from that you subtract all the liabilities of the company. If a company is trading below that number, it is a deep value stock, it is potentially a good investment. For example, let's say a company has $100 million in current assets, and the total liabilities of the company, total, not just current liabilities, is only $50 million. So the net current asset value will be $50 million, 100 minus 50. And if the company is trading at a valuation at the market price, the market cap of the company is 25 million, it is undervalued according to this calculation. One example I can give you of such a stock was GameStop in 2019 when I was investing in the company. It was a deep value stock. What about GoPro? It's not. The net current asset value is around $140 million, while the market capitalization of the company is over $700 million. So it is not trading below that net current asset value. We cannot call GoPro a deep value stock, but maybe we can call it a value stock, because for a technology company to have a positive net current asset value, this is something very rare. But GoPro is in such a situation. You look at the balance sheet today, let's forget about the net current asset value. The balance sheet itself, like you would look for any other company. The company has a book value of about $600 million, and it is trading at $700 million. So it is trading fairly close to its book value. And even if you look at the tangible book value, $465 million, it is trading at a good valuation for a technology company. And this company has a very strong brand, a very valuable brand. So we cannot just look at tangible book value. And even when we look at the book value, goodwill and intangible assets, this doesn't include the real brand value of GoPro. So looking at GoPro today, if we include the brand value plus the book value of the company, that is all the assets minus liabilities, in a way we can say that GoPro is trading under that book value plus brand value, which means it may be a good investment. But we always need to dig deeper to understand really why the company has such a good balance sheet. And only recently the company has been able to build such a great balance sheet, and it's because of a massive tax benefit that the company received. I'm not going to go into details while they receive this tax benefit, but we need to understand that this is a one-time event. It's not going to happen every year that the cash of the company is going to increase that much. But still, for any company having so much cash right now, there are many options in front of them. Maybe they can pay dividends, or maybe they can buy back shares. Actually, GoPro is buying back shares. And you look at the company over the past decade, they have been aggressively making use of stock-based compensation. So the number of shares outstanding of the company has been increasing rapidly. Now it is stabilizing, and it's because they are buying back shares. They are buying back shares at such a rate that the number of shares outstanding is going to stay more or less constant. It's not like Apple is doing, that they are reducing their number of shares outstanding. This is not the case with GoPro. So this is something that you need to be careful about if you're interested in this company, because it's not that they are buying back shares that your ownership of the company is going to increase. It's going to stay the same because they are always diluting shares to give to the employees of the company. Okay, there is nothing to worry about. This is a small technology company. Maybe they are doing this, they are growing. We should not be worried. But are they really growing? Because if you are talking about a technology company paying its employees in shares instead of cash, they should be growing. But you look at GoPro, it's not growing. And that's why now we come to the income statement and cash flow statement to understand really what's happening to GoPro. You look at the revenues of the company in 2020, of course, nobody was going out, revenues fell. 2021, there was a recovery. Revenues went up again, and 2022, it is going down again. So over the past 5 years, revenues have been more or less constant. And if you look at net income, you look at free cash flow, only in 2021, they had a massive increase in net income and free cash flow because of the tax benefits. But after that, it is very low. They have very low margins. When they are going to give you their margins, they are always going to give you the gross profit margin. But it doesn't matter. What matters is what on the bottom line. What matters is net income and, more importantly, free cash flow. And this company, over the long term, they have been unable to generate positive free cash flow. So it is not a growth stock because they are unable to grow. They have a good balance sheet. Maybe they will buy back shares and things will stabilize. But how are we going to value the company? Are we going to value it based on the balance sheet? Because I told you, in a way, we can say it is undervalued because let's say it has $465 million in tangible book value. And you add 200 million for all intangible goodwill plus the brand value. So 665 million will be the intrinsic value of the company. The market cap is about 700 million. So it is fairly valued in this way. Some people might say the brand value is more than that because GoPro is a very famous brand. We put 300 million, then it is undervalued. But then when we look at the income statement, it is another picture. This company is not growing. And one way to calculate the intrinsic value of a company is to discount future cash flows. And this company is not producing cash flows. So what do we do next? We need to understand the business itself, where it is going. The business, GoPro, they make these cameras for extreme sports. If you're going in nature, you're climbing mountains, maybe you need these GoPro cameras. But most people don't need them. Most people will use a smartphone. So that's why they started losing market share in the overall camera market. But they are switching their business. Before, it was selling these cameras in retail stores, on Amazon. But now they want to sell these on their website itself, GoPro.com. And they also have subscription. You can subscribe for $50 a year and you have $100 off on a new GoPro. You have unlimited cloud storage, 50% off accessories. They also have a video editing app which is called Quick. And if you subscribe for $50 per year, you have also Quick. But if you can subscribe to the app separately. And today they have over 2 million subscribers. The number of subscribers is growing rapidly. So they are switching their business from mainly selling to retailers, and the retailers are going to sell, to selling online on their own website, plus using subscription, which means that the company is going to increase margin. This is where they want to go. They are going to increase margin. But also volume is decreasing because fewer people are buying their cameras. Volume is increasing, but they are increasing margin. So overall, I believe that they will be able to manage a slow increase in revenues. And they are also going to improve on margins, and probably they are going to be profitable with positive free cash flow. Good. But if we discount this, then GoPro is not undervalued today. Because I did the calculation. You can find everything on my research platform. If you're interested, you can have a 1 month free trial. You have all my analysis along with my investing course for beginners. When I calculated the intrinsic value of GoPro using this method, it is not undervalued. So using the balance sheet, I would say it is fairly valued, and using this method, it is not undervalued. So which one should we choose? Actually, a combination of both. We need to understand the business. GoPro is in the business of selling those cameras. If GoPro was in the business of buying back shares, was a financial company, then maybe I would have based the valuation on the balance sheet. But this is not the case. You're investing in a business, you expect the business to be able to use its cash to grow. But this is not happening. The success of the company is dependent on that business switch they're making into going to a subscriber-based business. Will it work or not? We don't know. So that's why I decided, for the time being, GoPro is not a good investment for me. I had a conversation a few years ago when I looked at GoPro with a few popular investors on eToro who invested in GoPro, and they compared it to a lemonade stand. But my answer was that if you are a lemonade stand and all your profits come from tax benefits, I won't call you lemonade stand anymore. You're just here to make cash from tax benefit. You're bad at selling lemonade, so why would I invest in your company? Same thing for GoPro. It is a good company, it has a good balance sheet, but they are bad at the business that they are doing. And that's the problem with GoPro. It's not just about the balance sheet. Okay, I like your balance sheet, beautiful balance sheet. Sell me all your assets, sell me your liabilities too. But at what price? Because your business is about business. At what price are you going to sell this to me? It should be at a reasonable price. It's not just about the balance sheet, it's about the future growth of the company. So that's why for me, GoPro is not a good investment. At least for now. If the stock price keeps falling, or the business really they have this transformation, this transition, and things are getting better for them, then maybe I can invest in the company. A business that I have been investing in, and the business also switching to subscriber base, but this one is a little different. It's Geo Group. I have recently made a video about Geo Group, so if you're interested, please watch the video. Have a nice day and goodbye.